Turning to inflation, food price uncertainties continue to weigh on the inflation trajectory going forward. A record Rabi wheat production would help temper price pressures and replenish the buffer stocks. As you would recall, the buffer stocks had slightly dipped, but I think the record Rabi production of wheat is expected to replenish whatever depletion had taken place. Moreover, early indication of a normal monsoon augurs well for the Kharif season. International food prices also remain benign. The tight demand-supply situation in certain categories of pulses and the production outcomes of key vegetables warrant close monitoring, especially in the background of the forecast of above normal temperatures in the coming months. And these above normal temperatures, as per the current forecast, are expected to prevail in April, May and June, and not beyond June. That is the current forecast. Frequent and overlapping adverse climate shocks pose upside risks to the outlook on international and domestic food prices. Cost push pressures faced by firms are seeing an upward bias after a period of sustained moderation. Deflation in fuel is likely to deepen in the near term, following the cut in LPG prices in the month of March. Notwithstanding the cut in petrol and diesel prices in mid-March, the recent uptick in crude oil prices, especially in the recent few days, they need to be very closely monitored. Continuing geopolitical tensions also pose upside risk to commodity prices and supply chains. Assuming a normal monsoon next year, CPI inflation for, when I say normal monsoon for next year, I mean the current year 24-25. CPI inflation for the current year 24-25 is projected at 4.5%. I repeat, CPI inflation for the current year 24-25 is projected at 4.5%, with Q1 at 4.9%, Q2 at 3.8%, Q3 at 4.6%, and Q4 at 4.5%. The risks are evenly balanced. Now, what do these inflation and growth conditions mean for monetary policy? I have explained the growth situation, I have explained the inflation scenario. Synthesizing everything, what does it mean? What implications it has for monetary policy, and that is precisely what I would like to explain now. Inflation has come down significantly but remains above the 4% target. Food inflation continues to exhibit considerable volatility, which is impeding the ongoing disinflation process. High and persistent food inflation could unhinge anchoring of inflation expectations, which is underway. Our ongoing effort is to ensure fuller transmission of policy actions and anchoring of household inflation expectations. The strong growth momentum, together with our GDP projections for 24-25, give us the policy space to unwaveringly focus on price stability. Now, 2 years ago, around this time, when CPI inflation had peaked at 7.8% in April 2022, the elephant in the room was inflation. The elephant has now gone out for a walk and appears to be returning to the forest. We would like the elephant to return to the forest and remain there on a durable basis. In other words, it is essential in the best interest of the economy that CPI inflation continues to moderate and aligns to the target on a durable basis. Till this is achieved, our task remains unfinished.